When it comes to filing your taxes, one of the most important decisions you'll make is whether to take the standard deduction or to itemize your deductions. This choice can have a significant impact on how much tax you owe or how much of a refund you receive. Many people simply choose the standard deduction because it's easier, but for some, itemizing can lead to greater tax savings. In this video, we'll break down what each option means, why the choice matters, and how you can determine which is best for your situation. Let's start by understanding the basics of tax deductions. A tax deduction is an amount that you can subtract from your total income, which reduces the amount of income that is subject to tax. Deductions are a way for the government to recognize certain expenses or situations that should lower your tax bill. For example, if you have mortgage interest, medical expenses, or charitable donations, you may be able to deduct those from your income. The lower your taxable income, the less tax you pay. Understanding deductions is the first step in making the right choice between standard and itemized deductions. The standard deduction is a fixed dollar amount that the IRS allows you to subtract from your income, no questions asked. The amount depends on your filing status, single, married filing, jointly, head of household, and so on. Each year, the IRS adjusts these amounts for inflation. Most taxpayers take the standard deduction because it's simple and requires no extra paperwork. But is it always the best choice? Let's look at how it compares to itemizing. Itemizing means listing out specific expenses that the IRS allows you to deduct, such as mortgage, interest, state and local taxes, medical expenses, and charitable contributions. If the total of these itemized deductions is greater than the standard deduction, it makes sense to itemize. However, itemizing requires more record keeping and documentation. It can be more time-consuming, but for some taxpayers, the extra effort can lead to significant tax savings. Choosing between the standard deduction and itemizing can make a big difference in your tax outcome. If you take the standard deduction when your itemized deductions would have been higher, you could end up paying more in taxes than necessary. On the other hand, if your itemized deductions are less than the standard deduction, itemizing doesn't make sense. That's why it's important to compare both options every year before filing your taxes. The standard deduction is a great choice for many taxpayers, especially those who don't have a lot of deductible expenses. If you rent your home, don't have significant medical bills, or don't make large charitable donations, the standard deduction is likely your best bet. It's also the simplest option, requiring no extra forms or receipts. For most people, especially those with straightforward finances, the standard deduction is the way to go. Itemizing is ideal for taxpayers who have significant deductible expenses. If you own a home and pay mortgage interest, have high medical bills, or make substantial charitable contributions, itemizing could save you more money. It's also worth considering if you pay a lot in state and local taxes. The key is to add up your potential itemized deductions and see if they exceed the standard deduction for your filing status. Some of the most common itemized deductions include mortgage interest, property taxes, state and local income taxes, medical expenses above a certain threshold, and charitable donations. Each of these categories has its own rules and limits, so it's important to keep good records and understand what qualifies. By tracking these expenses throughout the year, you'll be better prepared to decide whether itemizing is right for you. The standard deduction amounts change each year and depend on your filing status. For example, in recent years, the standard deduction for single filers has been around $13,000, while married couples filing jointly can claim about $26,000. These amounts are adjusted for inflation, so it's important to check the latest figures before you file. Knowing the current standard deduction helps you compare it to your potential itemized deductions. To decide which deduction to take, start by gathering all your financial documents, including receipts for deductible expenses, add up your potential itemized deductions, then compare the total to the standard deduction for your filing status. Whichever is higher is usually the better choice. Many tax software programs can help you make this comparison quickly and accurately. Tax software has made it much easier to compare the standard deduction and itemized deductions. These programs can guide you through the process, ask the right questions, and even suggest which option will save you the most money. If you're unsure, using tax software or consulting a tax professional can help you make the best decision for your situation. If you decide to itemize, you'll need to keep detailed records of your deductible expenses. This includes receipts, bank statements, and any other documentation that supports your claims. The IRS may ask for proof if you're ever audited, so it's important to stay organized. Good record keeping not only helps you claim all the deductions you're entitled to, but also protects you in case of questions later on. Medical expenses can be a significant itemized deduction, but only the amount that exceeds a certain percentage of your adjusted gross income, AGI, is deductible. For most taxpayers, you can deduct medical expenses that are more than 7.5% of your AGI. This includes things like doctor visits, prescriptions, and even some travel costs for medical care. If you have high medical bills, this deduction can make itemizing worthwhile. Homeowners can deduct the interest paid on their mortgage, which is often one of the largest itemized deductions. This deduction can be especially valuable in the early years of a mortgage when interest payments are highest. There are limits on the amount of mortgage debt that qualifies, so be sure to check the current IRS rules. If you own a home, this deduction alone can sometimes make itemizing the better choice. You can also deduct state and local taxes you've paid, including income, sales, and property taxes. However, there's a cap on the total amount you can deduct, currently $10,000 per year. This deduction is especially important for taxpayers in states with high taxes. If your state and local tax payments are significant, this deduction can push your itemized total above the standard deduction. Donations to qualified charities can be deducted if you itemize. This includes cash donations, as well as the value of donated goods. Make sure to keep receipts and records for all charitable contributions. There are limits on how much you can deduct based on your income, but for many taxpayers, charitable giving can be a meaningful way to reduce your tax bill while supporting causes you care about. There are a few other deductions you can itemize, such as certain unreimbursed employee expenses, investment interest, and casualty or theft losses. Each of these has specific rules and thresholds, so it's important to review IRS guidelines or consult a tax professional. While less common, these deductions can add up and make itemizing worthwhile for some taxpayers. Some itemized deductions have limits or phase-outs based on your income. For example, the deduction for medical expenses only applies to costs above 7.5% of your AGI, and the state and local tax deduction is capped at $10,000. High-income taxpayers may also face additional limits. Always check the latest IRS rules to make sure you're claiming the right amount. Choosing the right deduction can directly affect the size of your tax refund or the amount you owe. If itemizing gives you a larger deduction, you'll pay less in taxes and could get a bigger refund. On the other hand, if the standard deduction is higher, you'll want to take that to maximize your savings. This is why it's so important to compare both options carefully. Your filing status single, married filing jointly, head of household, or married filing separately determines the amount of your standard deduction and can also affect which itemized deductions you can claim. For example, married couples filing jointly get a higher standard deduction than single filers. Make sure you know your correct filing status before making your deduction choice. Having dependents can also impact your deductions. While the standard deduction itself doesn't change for dependents, you may qualify for additional credits or deductions, such as the child tax credit or the earned income tax credit. These can further reduce your tax bill and increase your refund, so be sure to consider all your options. If you're married but file separately, both spouses must either take the standard deduction or both must itemize. You can't mix and match. This rule can affect your decision, especially if one spouse has significant deductible expenses and the other does not. Coordination is key to maximizing your tax benefits as a couple. Tax laws change frequently, and recent years have seen major updates to deduction rules. For example, the standard deduction was nearly doubled in 2018, and some itemized deductions were limited or eliminated. Always check the latest IRS guidelines or consult a tax professional to make sure you're following current rules and maximizing your deductions. The Tax Cuts and Jobs Act of 2018 made significant changes to deductions. The standard deduction was nearly doubled, while some itemized deductions were capped or eliminated. For many taxpayers, this made the standard deduction the better choice. However, if you have large deductible expenses, itemizing may still be worthwhile. Understanding these changes is crucial for making the right decision. Good tax planning can help you maximize your deductions. For example, you might bunch charitable donations or medical expenses into a single year to exceed the standard deduction and make itemizing worthwhile. Planning ahead and keeping good records throughout the year can help you take full advantage of available deductions and minimize your tax bill. Whether you take the standard deduction or itemize, keeping organized records is essential. Save receipts, bank statements, and any documents related to deductible expenses. Consider using a digital app or spreadsheet to track your expenses throughout the year. Good record keeping not only helps at tax time, but also protects you in case of an audit. Itemizing deductions can increase your chances of being audited, especially if you claim large or unusual expenses. The IRS may ask for proof, so it's important to have documentation for every deduction you claim. While audits are rare, being prepared can save you time and stress if you're ever selected for review. It's important to understand the difference between tax credits and deductions. Deductions reduce your taxable income, while credits reduce your tax bill dollar for dollar. Both can lower your taxes, but credits are generally more valuable. Make sure you're taking advantage of all credits and deductions you qualify for. The standard deduction is a set amount that reduces your taxable income. It's available to all taxpayers who don't itemize and is designed to simplify the tax filing process. The amount varies based on your filing status and is adjusted annually for inflation. Itemized deductions are specific expenses that the IRS allows you to subtract from your income. You must list each expense and provide documentation. If your total itemized deductions exceed the standard deduction, you'll pay less in taxes by itemizing. Adjusted gross income, or AGI, is your total income minus certain adjustments, such as retirement contributions or student loan interest. Many deductions and credits are based on your AGI, so it's a key figure in your tax return. Taxable income is the amount of your income that is subject to tax after all deductions and exemptions are applied. Both the standard deduction and itemized deductions reduce your taxable income, which in turn lowers your tax bill. Your filing status determines your standard deduction amount and eligibility for certain credits and deductions. Common statuses include single, married filing jointly, married filing separately, and head of household. Choosing the correct status is essential for accurate tax filing. Tax credits directly reduce the amount of tax you owe, dollar for dollar. Unlike deductions, which lower your taxable income, credits lower your tax bill itself. Examples include the child tax credit and the earned income tax credit. An audit is a review of your tax return by the IRS to ensure accuracy and compliance with tax laws. Itemizing deductions can increase your audit risk, especially if you claim large or unusual expenses. Good documentation is essential if you're audited. Let's visualize how the standard deduction and itemized deductions affect your taxable income. Imagine your total income as a large block. The standard deduction is a fixed slice taken off the top, while itemized deductions are a collection of smaller slices that may add up to more or less than the standard deduction. The goal is to subtract as much as possible to lower your taxable income. To itemize, you need to gather all your deductible expenses and add them up. This process involves collecting receipts, statements, and records for each category. The total is then compared to the standard deduction to see which is higher. Let's look at a schematic of the itemizing process. Let's see a simple example. Suppose your standard deduction is $13,000, but your itemized deductions add up to $15,000. By itemizing, you reduce your taxable income by an extra $2,000, which could save you hundreds of dollars in taxes. Visualizing this can help clarify the benefit. Proper documentation is key when itemizing. Let's visualize a checklist of the documents you should keep, such as receipts for medical expenses, mortgage interest statements, and records of charitable donations. Staying organized makes tax time much easier. When married couples file separately, both must choose the same deduction method. Let's illustrate this rule with a simple schematic showing two tax returns side by side, both marked as either standard or itemized. Tax law changes can affect your deduction choices. For example, the 2018 tax reform increased the standard deduction and limited some itemized deductions. A timeline schematic can help visualize these changes over time. Your choice of deduction affects your refund. Let's visualize how a larger deduction leads to a bigger refund or a smaller tax bill. A simple flow diagram can show the relationship between deductions, taxable income, and refund amount. Medical expenses are only deductible above a certain threshold. Let's illustrate this with a bar showing your total medical expenses, with a line marking 7.5% of your AGI. Only the amount above the line is deductible. Charitable deductions are limited based on your income. Let's visualize this with a pie chart showing the percentage of your income that can be deducted for charitable contributions and the portion that is not deductible. Choosing between the standard deduction and itemizing is one of the most important decisions you'll make when filing your taxes. By understanding the rules, keeping good records, and comparing your options each year, you can maximize your tax savings and avoid paying more than you need to. Remember, tax laws change frequently, so stay informed and consider consulting a professional if you have questions. Making the right choice can put more money back in your pocket.